All right, joining me now, we bring in Mike Ozanian, who's assistant managing editor at Forbes Media and also the host of the weekly sports, what's it called?
Forbes Sports Money.
On Yes Network.
Correct.
I had to get that in. Producers will apologize to you later. And we know Joe LaVorgna, chief economist at SMBC and former economic council chief economist and senior fellow at AFPI. Mike Ozanian, start with you. As bad as things sound with banks and this and that, I was scrolling around today. The Atlanta Fed's GDP now is showing 3.2% at an annual rate in Q1, which is a big number. And this will be the third consecutive almost 3% growth number. So rogue banks on the West Coast may or may not be falling apart, but the economy looks very good.
Yeah, I'm a pessimist. I don't really believe that number. I think things are going to come in much worse. Listen, I'm just going to...
Silicon Valley Bank.
I'm a simple guy. Forget about the banks for a second, Larry. I'm just going to go with the fact that real wages are falling. Mm-hmm. I'm going to go with the fact that corporate profits are expected to be down significantly in the first and second quarter, possibly rebound in the third and fourth. To me, that's not a good sign. And, you know, the blueprint to get out of this sort of a mess, if you're going to have problems with inflation, is what we saw in the early Reagan years, which is more deregulation, tax cuts. Mm-hmm. What we're getting now is from the Biden administration, more regulation, and oh, by the way, let's tax success even greater. Yep. So I'm very skeptical of that Fed growth number.
But I got to tell you, I mean, the Atlanta Fed doesn't get it precisely right, but they have a good track record, Joe LaVorgna. You've been looking for a recession. We haven't had it. And
well, we had the inflation recession.
You had the first half of 2022. But Q3, I want to be honest here. Yeah. I mean, I'm not a Biden supporter, but the fact remains, Q3 was strong, Q4 was strong, Q1's going to be strong.
Well, we don't know the Q1's going to be strong.
Retail sales, by the way, that feed into GDP were very strong.
Yes,
very strong.
The autos are going to be soft, and all the housing-related components that aren't part of the core are going to be soft. This is what's important. This whole banking issue is in part, or in large part, a function of the fact that the short-term borrowing rate, the rate with which banks borrow at, is going to, in the Fed's mind, 5% plus. Some people saying even 6%. That yield curve is massively inverted. Mm-hmm. The banking system isn't profitable. You could backstop all the deposits. You could guarantee everybody. But the business model doesn't work if your cost of funds is higher than what you could lend them at. So the more the Fed raises rates, Larry, the more deposits are going to come in aggregate from the banks. The FDIC last year lost the most amount of bank deposits ever.
I just know.
And the Fed is going to wreck the banking system.
Everything looks bad except for the actual economic accounting. All right?
Well, hold on, but we don't know. But Larry, we don't know the first quarter is going to be 3.2. We've got very little to go on.
I'm going to bet.
And I would say it's going to be under.
It might be under. You always say it's going to be under.
No, I don't.
It might be 2.7.
Well,
but
they were right in 2020.
The Fed's inflation rate is still 2 to 3 times the 2% target rate. Do they tighten again? They might pause next week because of the banking uncertainty, but they're going to come back in April, May, June, et cetera, or not.
I believe they will. There are a lot of people betting on stocks, buying stocks, think they will not, Larry.
Stocks roaring, by the way.
Based on that Fed put. But I think they will, because if you compare it to something like the Taylor rule, the Fed funds rate has got to go at least 6 and probably higher.
That's what John Taylor said on this show. He said 6% plus. That's exactly what he said. They're at 4.5 to 3/4 right now. I think interrupting, they may stop for a bit because of the banking, but I think they have to beat inflation, not growth. Growth's not their job. You were right. Taxes and regulations what gives you growth and open up the spigots for fossil fuels. But, Joe, you're going to tell me the Fed should be easing right now,
I'm going to tell you that if John is right and the funds rate gets to 6 plus,
the unemployment
Taylor. Right. The unemployment rate will be at 6%, and everybody who's arguing right now the Fed should be hiking to kill inflation be the ones arguing the loudest next year to be cutting rates because we'll be in a deep recession.
I just find this story very amusing. Everyone is pessimistic about the economy except the numbers. I'm just saying that, okay? And I'm a numbers guy. I know what I see. Won't last. You've never had an inverted curve like this for so long without a recession. It may not come till next year. But I'm saying right now, Achilles is yelling at me. I got to get out. It's very tricky.
But
You gotta
housing
admit,
and
it's very
manufacturing
tricky.
are in
They're
recession.
all terrible.
Those numbers
I
aren't
agree
good.
with you. They're all
Those
going
are the
down.
two leading indicators.
Everything's going down except the consumer and real GDP. Mike Ozanian and Joe LaVorgna, thank you very much.